Hi everyone, I'm Michael Lovett, Head of Distribution here at Vanguard. Thanks for joining us today for our ETF Fundamentals live webcast. We hope that today's webcast will give you a better understanding of what exchange-traded funds, or ETFs, are and the benefits of investing in them. Joining me today are two experts in their field, Robin Bowman, our Head of Market Strategy, and Damien Sherman, our ETF Product Manager. Rob and Damien, thanks for joining us.
It's a pleasure.
Over the next 30 minutes, Damien and Robin will offer their insights on ETFs and give us a sense of how and why ETFs can be a good fit for your clients' portfolios. We'll spend most of the session answering your questions. You can start submitting by clicking on the Ask the Question tab on your screen. To get started, I thought it would be good to set the scene around ETF landscape. Robin, ETFs around the world have hit 2 trillion in assets. In Australia, it's just over 11 billion now. Why have they been so popular?
Well, Michael, ETFs have really been the growth story of the last 15 years in the global financial service industry. Started in the US as institutional tools, really for large pension funds looking to do asset allocation. But then we've seen them taken up by retail advisors, and advisors who particularly were moving their businesses into an asset allocation model, and they were looking for tools to build portfolios to clients out of. And really, ETFs are just such a powerful asset allocation tool. In Australia, to be fair, we've actually lagged the rest of the world by some years, partly because of regulatory rules. But once they were changed, we've now seen the launch of ETFs, and we've seen the market. You can see on screen here, the market growth looks exactly like the US did about 10 years ago, and we expect that the growth in ETFs and with it index investing to continue.
And Damien, I think most advisors actually have heard about ETFs, but just so we're on the same page, can you explain what they are and what the benefits are?
Yeah, certainly, Michael. So ETFs are basically an index managed fund that investors access through the exchange. So they trade exactly like a direct share, where you go to your broker account and you buy and sell the share in that fashion. So the benefits of ETFs are really around the fact that they're very low cost. You get very broad diversification at a very low management fee. And they're very well diversified even within the product. Their exposure is spread across many securities. And they're also very transparent. So they're transparent in that you can see the securities that you're investing in. And when you're buying and selling it, you're doing it very close to that net asset value. And the fourth benefit of them is their liquidity. It's very easy for investors to access them. You can go on the market in very small amounts and in very large amounts and pick up that exposure very close to that net asset value.
Thanks, Damien. You speak to a lot of advisors about how they actually build their portfolios for clients. Can you speak to us about some of the more popular ways advisors are using ETFs?
Yes, of course. What we see advisors and their investors doing these days is really using ETFs in a number of different ways, and they really are very flexible, so there are many ways that investors can use them. What is very common is to use them for international exposure. So a lot of self-managed super funds are very heavily invested in domestic equities, and their advisors are expanding the breadth of their portfolio by going into international securities, and you can very easily do that with 1 or 2 trades. Another common strategy is to use them to implement a specific strategy. That might be to take advantage of high dividends and franking credits. It might be to take advantage of international exposure. There are some advisors that really jump in with both feet, and they set up an all ETF portfolio, and what they're able to do is to diversify that portfolio across asset classes. They can have exposure to domestic equities, to fixed income, international shares, and property. So the fourth way we see them being used is the combination of those strategies. Start with a core, that well-diversified portfolio, and then put some satellites around that. And that can be investing in direct shares or taking one of those strategies of income or international exposure.
Thanks, Damien and Robin. Now for the fun part, we'll start with the questions. We've got quite a few coming from the field. The first one was one sent in prior to the day, Martin Morris in New South Wales. What is the main difference between using ETFs versus managed funds? Robin, can you start with that one?
Sure, Michael. The important thing to understand here is that an ETF is a managed fund. So the underlying portfolio is exactly the same, particularly when you're using the Vanguard ETFs. So in terms of the portfolio management point of view, they're the same. The real difference is at the advisor end in terms of, do you access it through the unlisted fund structure, through perhaps a platform, or do you go to the ASX and buy the ETF?
All right, the next question comes from Barry in Victoria. How can I use ETFs with self-managed super fund clients? Robin, you might go for that one as well.
Yeah, and we think ETFs are a fantastic product for self-managed super funds because, as Damien mentioned, you often see SMSFs with concentration in Aussie equities and a lot of cash. So there's a risk within the portfolio that's, let's say, like last year, the international markets have a very strong run. ETFs are a great way for SMSFs to diversify their risk away. So it's not always just about return. You can actually diversify the risk within a portfolio from the concentration in Aussie equities and cash by using, 1 or 2, 3 trades, whether it be fixed income, international equities. So we've seen SMSF investors being early adopters of ETFs, and we can understand why.
No problem. Damien, one for you from Alicia in South Australia. Can you provide an example of how I might implement ETFs in a core satellite approach?
Yeah, it's a good question, Alicia. So what we see when investors are constructing these core satellite portfolios is that they will go through and give themselves access to different asset classes. They might invest in the Vanguard Australian Shares ETF for their domestic equities exposure, then go into fixed income to balance that out, and then they're looking for more diversification through international shares and property. Then what a lot of advisors will do is to put their own overlay on that. There can be a tilt towards particular countries. That might be a satellite. Might be the direct shares. A lot of investors really like having some direct shares. They like taking a position in them, and they can be your satellite to really where advisors like to put their own overlay across a portfolio.
No problem. Damien, another one for you from Nick Shug at SFG. Is it cheaper to access index funds via ETFs, and what are the disadvantages of going that way? It
is a little cheaper to go to ETFs as opposed to index funds. The management fees, particularly for our products, are slightly less. But what is really where you really pick up that cost benefit is in comparison to active funds. So if that's your basis of comparison, then they really are very, very low cost. And our Australian Shares ETF is at 15 basis points as an MER. That's 0.15%. So it really is very, very low cost access to the very broad exposure. And it's also the spreads that you pay on getting into the product are quite low and typically lower than the spreads that you pay on a managed fund. But you do need to remember that you're paying brokerage on that way through as well. So.
And Michael, I might jump in there too. One of the other things when people are looking at ETFs versus managed funds is to understand that for someone that's doing dollar cost averaging, so they're putting regular amounts of money in, then obviously the ETF has a cost, and that may be a case where the unlisted fund actually makes more sense.
Yep. Robin, one for you from Jim in Wagga Wagga. What is the benefits of using ETFs versus LICs?
Well, I think the main benefit with an ETF there is that they will tend to trade much closer to the net asset value. LICs typically trade either at a premium, which can be good, or at a discount. But the mechanism being open-ended with an ETF means that they trade much more closely to the NAV.
Yep, no problem. One from Sharon James for you again, Robin. How can I find out exactly what securities I'm buying into when I purchase an ETF?
Well, one of the advantages of an ETF is their transparency. So you can go to the website of the ETFs and look at the securities that are held. So you get a really clear idea. So you actually understand that, in the international ETF, you're buying the Apples, the large global names. So it's really transparent for clients.
No problem. Damien from Alex in New South Wales. I use a platform to manage my clients' investments. Can I buy ETFs through a platform?
Yes, you certainly can, Alex. Most of the platforms out there do have direct share access, so you can enter your trade in through the platform. It varies in the visibility that you get into the market, but platforms now have really stepped up their in what they're offering investors to get into listed securities.
Robin, I might throw this one to you from Romano in Victoria. Are ETFs tax efficient?
Well, that's an interesting question. I mean, ETFs are tax efficient in the sense that index funds are tax efficient because of the low turnover. So if you compare to an active fund, perhaps with 80-90% portfolio turnover, then yes, ETFs and index funds are much more tax efficient that way. But on other levels, they're obviously the same as a managed fund in the sense that franking credits, etc., pass through. But again, you know, for tax positions, you need to really look at the client situation.
Yep, no problem. Damien, I might try you on this one from Susie in Victoria. What are the risks with investing in ETFs?
Well, the risks with investing in ETFs are in many ways similar to the risks with any sort of investment. What you're buying, what you're taking is market risk. And that's the most important thing to think about. You have to think about whether you're happy with taking that position in the market. The other things to look at is look at the issuer who's offering you the product. And look at the index and how well constructed is the index that ETF is following. And apart from that, there really are very few risks. There's very limited counterparty risk with an ETF. There's very limited liquidity risk with an ETF. It's really very easy to get in and out at a good price because they do trade so close to that NAV. So it really is that market risk and which you need to be aware of.
No problem. I might throw the next couple at you too, Damien. Damien runs our ETF hotline, so it can help advisors with trading. So the next one is, do I have to have a brokerage account to buy ETFs from Roger in Victoria?
Yes, you do need to have a brokerage account. Sometimes this is provided by a platform, but in general you do need a brokerage account. So so that can be for an online brokerage account through CommSec or E-Trade. It can be through a full service broker, or again through your platform where they give you direct market access.
Yeah. And this is one of the most common questions we get. What's the best time of day to trade ETFs, from Nicholas in South Australia?
Yeah, it is a common question and a good question. The only thing to be aware of when trading in ETFs is really not to trade in the first 20 minutes of the day. So what's happening there is the prices are just coming onto the market, and so the market makers who supply the liquidity to the market, they're waiting until all of those prices of the underlying securities are set, and then they can rely on them. Once you get to 20 past 10 in the morning, then those prices will be up there. They'll be at nice narrow spreads, and there'll be plenty of depth in the market there for you to trade at. And it's a little bit the same at the end of the day. You want to be wary of trading with just minutes to go, 3 minutes to go, 4 minutes to go. You want to steer clear of there. So if you keep it to the middle of the day, after 20 past 10 and before 3:45, then you're fine.
And so what's another trap for trading that you would tell people?
An important one that we often remind people is really is to use limit orders as opposed to market orders. It's really important to do that. What I find interesting is that even in the US, where there's massive liquidity in these products and a lot of people using them, the people from issuers and market experts, they're all saying use limit orders. And that's because that way you can control the price that you're going to be filled at. And if you put a market order on, it'll probably work, but you are giving away control of what that price is. So you want to use a limit order, be sure of the price, and then thereby make sure that you get filled and you get executed that day.
No problem. Robin, we haven't heard from you for a while, so I'll ask this one to you. Could you explain the difference between the players in the ETF market, the issuer versus the market maker of an ETF?
Yeah, sure. I mean, and I guess the key point there is that when you look around ETFs, the industry globally, there are three major organisations that really run most of the ETFs, and there are a group of other people who are actually launched other different types of products. So it's really important to understand who the issuer is. You know, is it someone like Vanguard that you sort of know, and we've got global scale, etc., or is it somebody else with a different product? So that's really just I think from an advisor's point of view, normal sort of due diligence, understand the organisation that's behind it. In terms of the market makers, obviously that they're sitting there, as Damien just said, to provide liquidity. They're really working there on the side to actually make sure you can trade at NAV.
No problem. Damien, for you, from Craig in Victoria somewhere, can you confirm if one uses a global equity ETF, you will see the underlying securities?
Yes, we can confirm that. So if you're trading a global ETF, it might be our Vanguard Total Shares ETF, which is our US-based ETF, or the All World ex-US ETF. Both of them, they hold the underlying security, and you can go and see what those securities are. There's about 5,000 in the US product and about 3,500 in the All World. But you can go to our website, you can see a list of those securities and the number of securities that's in the basket for those products. So you do have full physical backing in those ETFs.
No problem. Rob, one from you, from Jenny at Premium Accountants. Is the main advantage of ETFs over managed funds the cost?
Well, certainly cost is a big factor. I mean, the thing about ETFs is I think they've really driven costs down. I mean, if you look at the cost of, say, our total market fund in the US at 5 basis points, I mean, you go back 10 years, large institutions were lucky to get that sort of price in the market. So, definitely the cost is a big factor in terms of how it works for clients, because, remember, in investing, the only thing that's certain is that the more you pay, the less you get.
Yeah.
And I'd just chime in with that one. There's a couple of other benefits that the ETF does offer, which is really about that intraday pricing. So a managed fund, you'll get pricing at the end of the day, and for the ETF, you'll get priced at the time that you execute. So that's an important difference to some investors out there.
Yep, no problem. Damien, for you, from Tim at Godfrey Pembroke, is there a hedged and unhedged option for the international ETF like the managed fund alternative?
No, currently there is not this option. So our international ETF product suite is across the VTS, the US product, the All World ex-US, and we have an emerging markets product. So, but that's definitely something that we look at to be able to offer investors access to a developed international equities developed market, and we're looking at ways that we can offer that, hedging it and of course unhedged. So.
And again, Michael, that's probably one of those points where you'd say when you're looking at an ETF versus a fund, if currency hedging is really important and there's a fund option which does have a currency option there, then that might make the investment decision sort of point you one way versus the other. But I think currency risk is a very significant issue for Australian investors, and we know that's it, and that's obviously something that's on the development plan.
No problem. So watch this space is what I'm hearing.
Yep.
Yeah. So the next question from Andrew Peters, is there any chance that you can list an industrial share ETF?
I mean, at an industrial shares ETF, you're basically talking about an active fund, and currently all of our ETFs and most of the ETFs in the market are all index based. So my feeling is the market will eventually get there, but it will take a bit of growth. We have to get people used to them and get them using it, and that probably the natural evolution of that will be active ETFs in the future. But even in the US, which is the most mature market in the world, they're only just starting to come out with these active ETFs. So again, watch this space, but it will take a bit longer.
No problem. The next two questions revolve around sort of dividends and franking credits, one from Louis and Edward Chu as well. Firstly, do ETFs investors receive dividends? And secondly, if the ETF pays franking credits, do I get them all? Robin, I might throw to you.
Yeah, well, I can kick off and Damien can perhaps answer the franking credits one. But yeah, I mean, as I said, ETFs are managed funds, so they work exactly the same way in terms of passing through dividends and franking credits. So anything that you expect from, say, an index managed fund, you'll get through with the ETF. So there's a very similar sort of structure. So from that point of view, yes.
And exactly the same with the franking credits. So they are included in the distributions. The fund collects all those franking credits, keeps a balance of them, and then distributes them through the distribution process, exactly the same as a managed fund.
And Robin, a question from me. You've done a lot of work around self-managed super funds and their tendency to hold direct securities, and also increasingly looking to ETFs. Can you just give us an idea of some of the analysis you did and what you found out of that?
Well, I guess the analysis that we did was really looking at the average SMSF portfolio, which typically holds about 18 shares, predominantly Australian equities. And what we've perhaps found there is that while the SMSFs actually perform pretty well through the GFC and beyond, they possibly have unintended risk where the clients are not aware of the level of risk within the portfolio. When you perhaps compare it to an institutional superannuation fund, the asset allocation is quite different. So all we're saying to advisors there is just perhaps have a conversation with clients that maybe by, for example, adding an international ETF to the portfolio, you can lower the SMSF client's risk. And at the same time, diversify that away and also obviously access that market's return. So it's really more of a risk discussion we're having there, but we do, I guess, have some concerns that with self-managed super funds, obviously a lot of self-directed investors in there working with advisors, but do they actually fully understand the risk that comes from having a pretty concentrated Aussie equity portfolio? And you just got to think about it, if the Aussie equity market's flat for the next 3 to 5 years, are the clients going to be happy?
No problem. Next question, Damien, interesting one. Why is ETF marketing overseas bigger than it is in Australia?
Well, the ETF market overseas is really enormous. As Robin was saying at the beginning, it's really grown enormously in the US over the last 15 to 20 years, and in Europe as well. It's really taken off. And if we look, and the marketing behind that has really followed the interest that investors have shown in it. The key reason that those markets are so much bigger is that the institutions play such a much larger role in those markets. Here in Australia, it's a little bit unusual where the institutions, large institutions, don't tend to participate in the market quite so much. It's definitely something we're working on to try and make that happen, and that's really the difference in the size of the assets under management and the size of the marketing that goes behind those products.
No problem. Robin, one for you from Jessica Chin in South Australia. What type of reporting do I receive with ETFs?
Yeah, I mean, essentially you receive the same level of reporting that you get from Computershare, typically the share registry, that they'll provide the tax reporting, etc., and the same as the managed fund. So, basic level of reporting coming out from the issue on that.
No problem. Damien, maybe you can answer this one from Daniel in New South Wales. I've heard of market makers trading in ETFs. Who are they and what role do they play?
Yeah, certainly. This is a really common question that I get when going out to advisors. So the market makers are there. They're typically large investment banks and trading companies, and they do trade the ETF. But what they're doing is they're collecting those ETFs from us. They buy them from us, and then they sell them into the market. So they're really serving that intermediary role. And so they're the ones who are making sure those spreads are really tight, and they're the ones who understand how they're priced, and they'll go in there and provide the prices there. They don't trade them, they don't take positions in those ETFs, and that's why you can be sure that when you want to get out of the product, the market maker will be happy to buy it from you. And they do that by hedging out their inventory, and so they're market neutral to those products. They buy them off us, and they take the equal and opposite position in a futures market or something, and they just serve that purpose of providing the product out through the exchange.
No problem. Got another question from Louis at my IFA. Do ETFs have performance fees, Robin?
The simple answer to that one is certainly not Vanguard ETFs. Can't speak for the entire market there, but not that I'm aware of.
Yeah. We might go to the next one from Tim. Damien, can you answer this? Can you go through a few option strategies over ETFs?
Well, of course, an ETF is a listed instrument just like any other direct share from that perspective, and it can have options put over it, and it can and players in the market can really do whatever they like with it. But at the moment, the market here in Australia, there are very few derivatives that are placed over the ETFs. There's a few installment warrants that are out there, which is effectively taking out an option in it. But that part of the market is not really very developed here in Australia. Really, the focus here in Australia is from those from SMSF investors and that bottom-up approach of investing for low cost and in diversified products.
No problem. Robin, I'll ask this one to you. How do you know that I've bought an ETF at a good price?
Good question. I guess that depends entirely upon what happens after you've bought it. But the answer there is if you're looking at the ETF and you understand what the NAV price is. So I think the trick there is to just ensure that you're paying something close to the NAV, because otherwise it's you're at a small amount of risk. You perhaps the spread's going to hurt. But I think the point there is just to be really clear about what the value is you're buying. And remember, these are index funds, so you're actually buying them to get exposure to a part of the market. And from a Vanguard point of view, we would say that should be a long-term position.
And this one relates, and Damien, you can probably answer this from Peter Johnson in Victoria. Why is it good for an ETF to trade close to the NAV or net asset value?
Because the reason that is so important and with an ETF is because that's how you get that transparency. What you're doing is buying a low cost fund and it does increase and decrease in value during the day, but that's a reflection of the underlying securities in that fund. What's important is that you're buying that product, the wrapper of those underlying securities, at the net tangible asset value of those products. So that's what we call efficient trading. You don't want to be buying it at a premium. You don't want to be selling it at a discount. That's what you're avoiding, and that's why ETFs are so popular, because when you buy them, you get what you're expecting to get.
No problem. Thanks, Damien. Another question, Rob, and this is for you. We get a lot. What is the difference between physical and synthetic ETFs?
Yeah, sure, Michael. I mean, the physical ETF, which is what Vanguard offers, is that, in the Australian equity ETF, it's going to own the shares in BHP, Westfield, Coles Myer, etc. So it actually physically owns the securities. On the synthetic side, which, in the Australian market there's not many of them, but in Europe particularly they're quite popular, is where the underlying comes from a derivative. So it might be a swap or something like that, which is actually a derivative structure to try and deliver that market's return, but going through that sort of derivative structure. So, there's a level of complexity to it. Again, goes right back to the start when we talked about understanding what the product is, what's the index, what's the mechanism to deliver that sort of market return. Vanguard, philosophically, we're much more strongly in favour of having physically backed ETFs so people know what they're doing.
So in Australia, Vanguard's ETFs are physical?
They're all physical. Yep.
Yeah, no problem at all. Unfortunately, we're out of time for today. So in summary, ETFs are a simple way to build low-cost, diversified portfolios for your clients. And they're really no more complex than a managed fund. We've received lots of great questions, but unfortunately we've not had time to answer them all. We'll contact you individually to respond to those that we haven't. Finally, if we could just have a few more minutes of your time, we'd love to hear your feedback. So please respond to a survey that will appear on your screen shortly. Thanks for joining us today, and we'll see you next time.